So the future of money actually started yesterday, so we're already behind. And what I'm going to do is, I'm going to talk about what money is. I'm going to propose a theory of how to think about money, and then I'll talk a little bit about stablecoins, and at the end about central bank digital currency. So in market economies, there's a primitive demand for a means to transact. And when there's no alternatives, privately produced money arises. This occurred in Sweden, and it's occurred in most countries. There's usually a shortage of metallic coins, and so banks issue paper money. Stablecoins are the latest privately produced money. But there's two problems with privately produced money. The first was identified by Ricardo, who said, in the use of money, everyone is a trader. Those whose habits and pursuits are little suited to explore the mechanism of trade are obliged to make use of money and are no way qualified to ascertain the solidity of different banks whose paper is in circulation. Accordingly, we find that men living on limited incomes, women, laborers, and mechanics of all descriptions, are often severe sufferers by the failure of country banks. So the way I think about what Ricardo's saying is, he's saying that if you have to use this private money in exchange, you're at a disadvantage because you're trading with somebody who has more information than you have, right? This occurs in many securities markets, but we don't want it to happen with money. We don't want you to have to accept a lower than face value for your private money. So Ricardo and others identified the solution, and the solution is to have a uniform price. That is, to have a price that doesn't change, okay? And that's very hard to achieve. Here's an example of a private banknote from before the Civil War in the US, when there were 1,500 banks, each issuing notes like this of different denominations. And of course, there were counterfeits and all kinds of problems. This is from Bull's Head Bank in New York. It's a $1 bill. And this is a good bill. You can tell because it's worn. Right? It's worn, which means it's passed through many hands. Many people have looked at it. The problem with these kind of bills is that the price has moved around. Right? So here's an example. This is Planters Bank of Tennessee trading or used as a note in Philadelphia. And you can see that the discounts ranged as high as 25%, which means this note was only accepted for 75 cents on the dollar, right? Now, these prices are efficient in the Chicago sense, right? So these prices are moving around because they reflect changes in risk factors. But it's not a very good medium for buying things because you don't know the value of this. So the solution here is to design money that doesn't have that property that the prices move around, right? That it's information insensitive, I'm going to call it, which means that nobody has an incentive to actually poke in around into what the backing is for this money. And everybody understands that it's too expensive to do that. So money is special because its price is constant, right? And when you take economics, the first thing you learn is about supply and demand, and resources are allocated via the price system, and prices move around, and you're shifting supply and demand curves in your first semester of economics. That's not how money works. Money has a fixed price. The goal is to have a fixed price. So a $1 bill trades at $1. Now that's going to be hard to achieve. And when it is achieved, I'm going to call it no questions asked. The money is accepted, no questions asked. Okay? So private money has never been able to achieve this. Okay? So the second problem is that privately produced money is subject to bank runs. And the reason is that if the price doesn't adjust, the only thing that can really adjust is the quantities. Right? So if the price doesn't adjust, nobody has probed into the backing for this note. And so if they're worried about it, what they do is they go to the bank and say, I want my cash. Okay, this is what happened in 2007, 2008 in the United States with institutions not liking the private money, which was in the repo market, and asking for their cash. So there's two problems. One is it's hard to design money to have a price that's constant. And secondly, there's this problem of bank runs. Now, stablecoins are the latest form of privately produced money. They're purportedly backed one-for-one with safe assets, that is treasuries, for example. So the issuers are basically unregulated banks. right? So they can go to the market, sell a stable coin in the market, take the proceeds and go invest it in something, which we're hoping is something that's relatively safe. And but they're unregulated. Now, stablecoins they provide liquidity in crypto space, but they also provide collateral. So a lot of demand for stablecoins comes from wanting to use them as collateral to back levered positions in buying, let's say, Bitcoin. Okay? So who cares? Well, the answer is stablecoins there's a big reason why they're going to grow. And the reason has to do with cross-border trade. So here's John Kunleaf. Despite technological advances, it can take as long as 10 days to transfer money to different jurisdictions. And that transaction can cost up to 10% of the value of the transaction. A payment from the UK to some countries has to go through 4 currencies and as many as 5 banks. This is kind of the extreme case. But the point is that blockchain is exploding on global supply chains. That's the natural place for it, right? So, for example, Maersk, the big shipping company, has developed with IBM TradeLens, which they've formed a coalition with these other 2 large international shippers. So cross-border trade now involves attaching a non-fungible token, say, to a container. And then when another shipper takes over the container, accepts it, the address of the non-fungible token is changed. Right? So that allows you to track this all in real time. And it's a very short step from that to saying, now I'm going to pay you. You delivered it. I see that you did on the blockchain, so I'm now going to pay you on the blockchain. Right? And this is already being developed by a company called Stripe, a fintech company in California. They're developing it for cross-border use for retail, for remittances. So this is where I expect that blockchain is going to go. So is this a serious issue? So it's a serious issue already. A 1 standard deviation increase in the issuance of major stablecoins, Tether and USD coin, on a given day results in a 10.7% increase in the commercial paper issuance quantity and a 20 basis point decrease in the commercial paper yield and a 15 basis point decrease in the treasury yield the following day. So even though you might think, well, the amounts of money we're talking about in stablecoins doesn't seem large compared to, say, the whole banking system, it's large enough to have a big impact on money markets. Okay, and as these things grow, there'll be a bigger impact on money markets, and that's not surprising. These are banks, right? So these other crypto firms, are sort of live out there in crypto space and have no physical location. Stablecoin issuers have to have a physical location because they have to have the real assets somewhere. They have to be stored somewhere, not in the US necessarily. Tether, the biggest one, is in the Bahamas. But what they do has an impact on money markets already. Okay? So what's the solution? Well, historically, we know what the solution is. Every single country on earth decided at some point that the government should have a monopoly over circulating money. And why is that? Because only the government can produce no questions asked money, right? That is not subject to runs and which trades at a constant price. So circulating money is a public good, and that's what governments supply. They supply public goods. So this seems like it's just an old question that we've confronted again. Now, in the conversation, this doesn't come up. I mean, I think in the last 3 months, I've probably given 15 talks or briefings about this, half of that to the Treasury and the White House and the Comptroller of the Currency and, the IMF and so on and so forth. And the issue of, maybe we should have a monopoly hasn't come up. Now, in many cases, what happened was the privately produced money was banned, right? Well, you can't do that with stablecoins, right? Because they're transnational. So what you can do, though, is have a viable central bank digital currency, which people will prefer over stablecoins, right? And that's what happened in the past. The government took over, although private money was banned. So the government can produce information-insensitive money, and private agents can't. Okay. So that, I think, based on my discussion with regulators and politicians, history is going to have to repeat itself. which means we're going to have a big financial crisis in 10 years, and then people will think about this seriously, and then we'll pass some legislation which maybe addresses things. Thank you.
There's very little new when it comes to money. Technologies change, but money is essentially what we have in our heads. And we've had money in our heads for a long time. And almost everything has been tried in the past in one form or the other. It was really enjoyable, given what I do, to read Gary's 3 background papers for this seminar and to sort of go through the list of what has happened in the past and why things ended up the way they did. So it's a tough act to follow when Gary has done it already. And given that I only have 20 minutes, bear with me, everything I'm saying is going to be sort of kind of telegraphic. Now let's see. But basically money is what society agrees it should be. That's what it is, because money is a convention. And you need to agree on some kind of a convention, because otherwise you can't exchange goods for money. And that's what we do. But it needs to continue evolving because technologies change. And this is sort of what all of you have read about in textbooks in one form or the other. Money is a medium of exchange, it's a unit of account, and it's a store of value. That's what we would like it to be. We started out with 20-kilo copper coins, physical banknotes, cards, and now maybe an e-krona in the future. And talking about this from a central banker's perspective, unit of account, store of value, that's monetary policy, inflation targeting, and all those things. But this today, what this is really about is the medium of exchange. And then there is one more angle to it, which is really, really important and what really matters. And Gary, in his papers, he calls it the convenience yield. And I call it transactional efficiency. It's one and the same thing, but if you don't have it, then people basically will start using somebody else's money. And that's why it is it's so important. And that, of course, also includes the no questions asked aspect of all of this. Let me add also one more dimension, which is not in Gary's papers, and this is not at all a critique of what's in the papers, it's just the way I've been sort of thinking about it lately. And what is it that I have here? I'm talking about wholesale money, retail money, which is something that households can hold, and I'm talking about state money in one form or the other, central bank money, and private sector money. And then you have the issue, who is the issuer, the state or private, and who has access? And this is what really matters. This is serious stuff, because access matters, because if you don't have access, then you might think that you have a problem. And if it's limited who actually has access, then that also affects the system. That's why you have the distinction between wholesale and retail. And this is it. If you look at what we have tried in this country in the old days, you had Riksbank, but during one period, actually, the National Debt Office issued its own money, wholesale and retail. And this happened from 1789 to 1792, and a number of years after that. To have two central banks in one country, that's a bad idea. That's the conclusion that comes out of that actually comes out of that. And this ended up with all sorts of problems, and there was no parity with Riksbank notes. So you had immediately a huge devaluation of debt office notes, about 50%. And eventually the whole sort of exercise was abandoned. And it maybe not something that sort of matters today, but one really has to be careful. And why is it that I'm raising this issue? Because if for one reason or the other, the political system decides that the Riksbank should not issue a CBDC, with a fairly high likelihood we will get a National Debt Office CBDC sooner or later. Because that's the only way to produce a safe assets. And that's why one should be careful about, how you set up these things. Now, then banknotes, and we had that from 1831 to 1904. They were both retail, and they were state Riksbank banknotes and private sector banknotes. It worked out, but it worked out because there were really, really strict rules on this. So basically, private sector banknotes were backed by a 30-35% reserve ratio in the Riksbank, and then in turn the Riksbank held gold. But then, of course, all the senior accrued to the banks, and eventually the political system did not like that, because if you have a central bank, you've got to make money from something, somewhere. And then that system was abandoned, so we ended up with what we have today, beginning in 1904. And basically now we have had a structure which has been constant, more or less constant, since 1904. And people have been happy with that. And now what is at stake is to what extent we want to maintain that structure or not. Or if we should just sit with our arms crossed, letting things happen, and then we say, oops, now we have a completely new world, now what? And this system has, as I said, it has served us well. But, and here you can see wholesale, retail, and the public, the general public has access to this type of money in one form or the other. But what also is important here, and this is where you get into the no questions asked issue. Also, when you're talking about private sector money here, everything is settled in central bank money, because that's the only way to deal with the no questions asked issue, so that you actually know what you are doing and how you can sort of transfer money from one entity to another entity. And now we are at a crossroads. This is where we are, because using this way of trying to probably, in too simplified a way, explain where we are, we have the Riksbank up here. We provide wholesale money to the banking sector. Retail is just on its way out, because people don't use physical banknotes anymore, and forget about coins, because 20-year-olds have never seen a coin. They don't use them anymore. And then we have private banks and with bank deposits and wholesale deposits in one form or the other. And then under here, and this is what you touched on earlier, we have, I call them unstable coins, and cryptocurrencies. And then the issue is really where this is going to go, and what will happen next. And this is where it gets tricky, because most people have never focused on these issues at all. And now we have to ask ourselves again, what is the role of the state supposed to be in this new environment where nothing is on paper and everything is digital in one form or the other? So society again has to agree on what money is in this environment, and either that is some kind of an active decision, or you just let it happen and then you see what happens. And if history gives us any guidance, and that's amply sort of talked about in your papers, so sooner or later you end up with all sorts of runs and financial crises in different shapes and forms. You need legislative changes when it comes to fiat money, because today most legal frameworks are tied to physical paper in one form or the other. So we actually need a legal framework which is technology neutral. I think that's the key to it. And there's an inquiry that working on this, the government inquiry, and they're expected to come up with a report in 2023. We will see what they will do and what they will say. And this is a non-trivial exercise, because mostly tech people talk to tech people, lawyers talk to lawyers, and economists talk to economists. But here these three groups of experts have to come together and define what electronic money is in a legal sense. So what do we do then? Let me then say a few words about what's going on presently when it comes to new forms of money and how I look at it. In my opinion, and this is my own opinion, so I'm not speaking on behalf of anybody else, I do think that public access to central money should be maintained in one form or the other. I think it would be a bad idea to construct a system such that only banks have access to central bank money and no one else. State money needs legal backing in one form or the other. Today, the legal tender status of Riksbank issued money cash today is weak. It's extremely weak. And I think that that's a problem in itself. And I think that legal tender should be technology neutral. And those of you who are actually interested in this, Stefan Lindskog, who used to be head of the Supreme Court in this country, has written 40 pages, but it's actually 150 pages because he has so many footnotes in the paper with a font size which is minimal, where he actually goes through all the legal aspects of this. And it's I really suggest you read that piece. And it's very, very interesting. Then, of course, it's very much legalese, and it's very much with reference to Swedish law, and it has not, as far as I know, been translated to English, but it's probably one of the better pieces in terms of looking at this from a legal perspective. And I think it should be technology neutral. And then we also need technology neutral regulation of private money. And it's very simple, same risk, same regulation. Otherwise, we basically end up with unregulated banks, and that takes us back to the 1800s. And then some of those banks are likely to collapse sooner or later in one form or the other. And many of those unregulated banks are essentially banks or money market funds or something similar to that. And then, of course, if you take various types of stable coins, if they're located in the Bahamas, you better go to the Bahamas and see if there is anything there. Maybe not. And that's an issue all in itself. So what are we doing today? And this is real stuff. This is actually work that is going on. So this is not fiction. In May this year, we started running our RICS instantaneous small value real-time gross settlement payment system, sending money from one cell phone to another in real time. The remarkable thing about this is that there are no transactions in the system. And that's when we get back to your issue of banks being very oligopolistic or monopolistic. So far they haven't been interested in using the system because it's just so efficient and so cheap. And they try to extract as much rent as possible for as long as possible. Eventually it will happen. Another strategic decision of ours is to basically stop running using our own large value real-time gross settlement system, and we will use in the future the ECB system for Target 2 and Target 2 securities, because it's much more efficient for us to just do a tiny kroner section of their system, which is designed to deal with euros all over Europe. And then we have an ongoing migration to new standards. This is highly technical, but eventually the whole world will be on ISO 222 when it comes to how you actually transact and how you define transactions. And we are getting very, very close to running this system 24/7, 365 days a year. There aren't really any limits to this anymore, at least not on the technical side. And the funny thing was that when we asked the banks, they came back and said, "Why are you extending the opening hours? We don't need that." And that really surprised me because, I mean, what kind of an answer is that? I mean, there's got to be some sort of competition in the system that somebody sort of realized that, hey, here's a wonderful opportunity. I can run this 24/7 while these other guys are leaving the office at 3 p.m. or 5 p.m. So it's gonna. I think it is going to change in one form or the other, and that's where we are on that. And then finally we will have the e-krona. We have done a ton of analysis. We are actually testing the e-krona. We're into the second phase, and the next year we'll probably move into a third phase. So the e-krona actually exists. You can take a look at it in various cell phones, and we know how to do it. But then, of course, it's quite a project to scale it. So now we can run it on a small scale, but if you want to do it for the whole country, then it's a completely different thing. And we have quite a lot of international cooperation when it comes to this, because of course many central banks are doing one and the same thing. So this is going to come in one way or the other. It's most likely going to come in many emerging markets, because they don't write memos for years and years and years. They just do. So here, those countries that have had reasonably good payment system for a long time probably will be a bit later than some others. And then finally, and this is really sort of an add-on to what you talked about, Gary. We are presently exploring cross-currency settlements in the TIP system, the system that will be used in the future for sending money from one cell phone to another. And the TIP system is owned and run by the ECBS system. And technically speaking, I think that within a year or so, we have solved the issue of how to move from Swedish krona to euros and vice versa in real time, 24/7, at an extremely low cost. Because it doesn't, of course, matter what kind, if you have one currency or if you have many currency, because the IT stuff that you need is exactly the same. We are cooperating with internationally, and there are many projects of a similar type that are dealing with this particular issue. If we are successful in doing this, and if our Nordic-Baltic friends want to join, then basically in our part of the world, we have solved the cross-border, cross-currency issue. But to make that happen, because we certainly can do it on the central banking side, then those who are extracting rent from the system presently will have to be willing to play along. Otherwise, somebody else will show up and sort of run away with the whole thing. And then, and this is also interesting, we sent out a press release, I think it was yesterday or the day before yesterday, on Project Icebreaker. And Project Icebreaker is a project where the Bank of Israel, Norges Bank, the BIS Innovation Hub, which is located here in Stockholm, the Nordic branch of this system, have agreed to develop a hub where you can move CBDCs around cross-border in this fashion. And I'm convinced that on the technical side, this issue will be solved within a few years. And there are numerous other projects of a similar nature in the central banking community dealing with this. But eventually, at the end of the day, it's never going to work if you only have central bankers talking to other central bankers. Eventually, the private sector has got to be involved in this in one form or the other. And either these things evolve in such a way that we and the banks cooperate on this and it happens that way, or if it doesn't happen that way, then new players will show up and then they will sort of do these things in the future in a more efficient way. So that's where we are. Thank you.
Thank you very much. So let me start by saying, my statements started out by saying this is the reality of what's going on, right? The reality, and you don't read about this in the Financial Times or something. The reality is that cross-border global supply chains are very quickly moving towards blockchain, and many of them already have. I mean, the containerization industry is almost all blockchain. So that's because it's more efficient to keep track of goods. But the correspondent banking system is so inefficient that it seems clear that the payment system will follow on these permissioned blockchains very quickly. And that's why I mentioned Stripe. Stripe has developed, it's essentially a retail system, but you can deposit USD coin and say, I want to move this to Turkey, but I want it to be in the local currency, and they'll do the FX transaction for you. So that's not blockchain based, but it's a use of a stable coin that we haven't seen. It's connecting with the real world. And those systems move. I mean, the private sector is very creative and moves very quickly. And I think that's it's hard to keep up if you're a central bank. I think nobody takes the first system seriously. Right. We should get rid of the banking system and have everybody deposit the money in the central bank. Then what do? Make loans? I mean, it's a crazy idea that was proposed maybe a few years ago, and the proponents got embarrassed and it was dropped. So it's the second system.
I mean, you need middlemen in one form or the other, because you can't really tell ex ante where these things are going to go over time. And if you live in the IT world and you think think about apps in many different ways, or electronic wallets, or whatever these things are called, then it's better actually to look at this in terms of the central bank being in the center of the whole thing, and then surrounding the central bank you have various participants, and then it's up to them to supply various types of wallets or whatever you call it in the future. So that's where it's going to end up. That's what I think. Well, it's not a point in itself to be totally transparent or for everybody to have access to everything, because that's where we have exactly the no questions to ask issue. I mean, ultimately, of course, at the end of the day, the central bank has to keep a ledger so that you know what you have issued and what is out there. But as to the rest, there is no need for everybody to know everything everywhere all the time, because that's kind of pointless. And it's probably also very, very resource intensive to set it up that way. Today, it's even possible to design systems such that if you use a digital, whatever you call it, currency or asset of some sort, where it's possible to design those systems in such a way that if you buy something, it's not possible for the buyer to follow everything and trace everything. And that's exactly the way it works with money today, because if I pay using physical banknotes and buy a cup of coffee, it's totally unrealistic, and it doesn't make any sense for those selling coffee to say, I would really like, when I'm looking at the numbers of this banknote, wherever it has been circulated in the world before that happens. So can be done. I mean, ultimately, it is a design issue, and it depends on the purpose and how you choose to design the system. And given that the views are very, very different in different parts of the world, and this is a value judgment in terms of whether you should anonymously be able to use money or not, it's likely to evolve. That's my guess, in different ways in different parts of the world. But when you're dealing with central bank money and when you're dealing with private sector bank deposits, forget about total anonymity. Because at the end of the day, then you end up with a conflict between anonymity and anti-money laundering and financing the terrorism legislation in one way or the other. So actually already today, at the end of the day, there is very little anonymity because of that. But if you want to create something which is super anonymous, then technically it's possible, but then they're with a fairly high likelihood fairly soon outside the law. Yes. because this...
I agree.
Yeah. Because this issue has been discussed forever, and given that we do not have a global parliament, and it takes, national parliaments have the monopoly right to issue laws. And that's where actually ultimately the power comes from when it comes to money. And so far, no one has been willing to cede those rights. It will be fairly low, but it will be there. And also another way of thinking about a CBDC is to say the following: a CBDC system is de facto increasing the safety of the whole system, because it's kind of an alternative to making payments. And that is probably a good thing, because it increases domestic redundancy. And I do think that in this day and age, that's a nice feature to have. But of course, it depends on the design. And suppose you don't pay interest on a CBDC. Well, then if banks pay interest on deposits, then it will be fairly low, but it is low use. But some people will always prefer to have a claim on the central bank instead of private banks. And then it depends on the setup and how efficient the connection is to the payment system in one form or the other. And here there's a tension here, because I always hear this argument: you got to be stupid, guys. Why are you doing this? Because the private sector will take care of this. But at the same time, I've said we have provided an extremely efficient, low-cost payment system which is not being used. And it's my job to ensure that the rents in the system aren't too high. And then it's my job to provide a public good such that there is a kind of a balance in the system as a whole.
I mean, it's going to be denominated in the domestic currency, so it's just like cash. I don't see any big change. I think the bigger change, just let me mention, is that the design of CBDCs looks like it's going to be bilateral because there's no central body organizing it. So if it's bilateral, that means in the future we won't use SWIFT. SWIFT is a messaging system, and as you have learned about SWIFT from the Russian sanctions, that data is very, very valuable. And so CBDC design, in my view, it also involves important national security considerations, because you want to understand how the data sharing is going to work between different CBDCs. And CBDCs are not going to be anonymous. There's different approaches, but large amounts, the identity is going to be known by the central bank. So I think that's where there's an issue, not with monetary policy.
No, I agree with that, because and maybe this is an oversimplification, is basically to say that the only thing we try to do when we talk about this is not inventing something totally new, roughly maintaining the system that we have today. And that's because technology changes. Keep in mind that the present system came or was constructed in a day and age when everything was on paper. And now we're sort of moving into a world where nothing will be on paper. And then the issue is, what kind of a structure do we want then?
I mean, the word "the system" is a bit nebulous. I mean, we've seen in crypto winter, which was basically a systemic crisis in crypto space, and we saw the collapse of large lending platforms and large hedge funds. And that had very little impact on the real world because it's all circular, right? A lending platform, they all lend to each other and trade with each other, and has nothing to do with real loans or anything. So that world is, I think it's a good thing, it's collapsing. But again, I don't see any real difference with CBDCs. I mean, just think of CBDCs as Stefan said, it's basically what you use now, only it's on blockchain. And blockchain, of course, is not invulnerable. It can be hacked, and it has all the usual problems.
But let me just add to that if you think about this in terms of vulnerabilities, I think it makes sense for any nation to maintain the capability to physically move physical cash around. But to maintain that kind of a system, you can't run it by the central bank itself, because you have to have a distribution network. It's like, in one form or the other, and you have to have the capability to deal with the logistics of that. And that I think that the only way to do that, if you want to maintain that type of a system, it's by law, because it costs money to transfer money. And private banks are profit-maximizing entities, so they will never do it out of their own sort of goodwill, so to speak.
So Diem is a very sad story, I think, because the CEO of Diem was Stuart Levy, who worked in the U.S. Treasury and was involved in getting access to SWIFT data to cut North Korea and Iran out of the international financial system. So Stuart is very aware of anti-money laundering, counter-terrorist, know your customer rules. And he worked very, very hard to satisfy those rules and was in constant discussions with the Fed. And in the end decided that, the Fed just basically gave up on him. I don't think they really understood what he was doing. And so Diem, was canceled. And it's unfortunate because Diem had announced that they would stop, or the government, the Fed could take over Diem as a central bank digital currency, which I thought was a very interesting idea. But Diem is no more. And it's very sad because Stuart was somebody who wanted to play the game honestly. And he lost, and the other stablecoins don't care about any of this, right? And they're outside the US, and who cares, right? Now they have fig leaves about, we follow know your customer stuff. Like Tether, you have to be pre-vetted in order to withdraw, and now there's minimum amounts to withdraw and so on. So, it's the good guys lost.
But might somebody try to attempt doing that again?
I think it's a
possibility?
I don't think so. I mean, I think the conclusion that was drawn is you can't be successful as a stablecoin if you're going to follow the rules.
And let me add to that. And it struck me because when this sort of showed up, I tried to read all the documentation on DM and this sort of moved around a bit over time. And what was very, very striking when I asked for all the documents trying to explain what this is and what they wanted to do, and maybe this is not completely correct, but it's roughly a reasonable ballpark number. They wrote probably a couple of 100 pages dealing with the technical specification of DM and all that stuff. Less than 10 pages on the legal aspects of what kind of money they were actually producing. And this is actually quite common because the tech guys, they don't care about the legal stuff. But if you don't care about the legal stuff, ultimately at the end of the day, you have nothing. Because then if you end up in court, you just don't know what's gonna happen. So, and that's why I stress this need to understand how you combine the technical specificities with a legal definition that holds of what you actually do or try to achieve.
Notice how he looks at me when he stresses this legal stuff. I want to mention, I did go to law school for 6 weeks. One more thing about Diem, which I think is important, is that Diem was connected to a real bank, Silvergate Bank, which is a state-chartered bank in California. And Silvergate is one of the 2 banks that's very connected with the crypto world. The Silverbank exchange network is very large, and they're upfront, they'll tell you how much volume they have and so on. So it's interesting because Silvergate, and the other bank is called Signature, sort of shows you a glimpse at the future of interoperability between crypto and our existing banking system. And I think that's something, if I was a regulator, I'd be a little worried about.
But let me add that, I mean, the whole conversation about DM, Facebook, and what was going on there was a very, very important lightning rod in the central banking community. Because before that, I was pretty much alone when it comes to international meetings when I said, hey guys, money is disappearing. Physical cash is disappearing. So we got to start thinking about this and we got to do something about it because otherwise we're sort of out of business. And then it has happened that I was told, yeah, but Stefan, you are the governor of the central bank, so can't you just tell people to use cash? and that would be the end of it. and no, that's not how it works. But once Facebook, DM, these new sort of phenomena showed up on the scene, the whole field changed almost overnight.
Libra was really interesting. I mean, when Libra was announced, the central banking world, had a collective heart attack. And it's really interesting to think about why. I mean, the fear was because Facebook has such a large, clientele, so to speak, if those people all started using Libra, the fear was that somehow that would evolve into kind of its own fiat currency, which, I can sort of imagine that happening, but since Libra didn't happen and Diem didn't happen, I don't see that as happening with the stable coins.
But to add to that, what most central banks in the world have realized, and this is serious business, particularly in a small open economy, is that producing something called the Swedish krona, that's a competitive business. And either you know what you're doing or you'll be out. And that means that people start using somebody else's money. And when that happens, forget about monetary policy because it will be decided elsewhere. Depends on how you organize the system, and it depends on how you set it up. And it doesn't really, at the end of the day, change all that much in a world without a CBDC, because then people would run from one bank to another And the only way to deal with that is for the central bank to end up being the lender of last resort in one form or the other. And if you have a run on the whole system and if there's no central bank money, then they would go for government debt in one form or the other. So you sort of never really get out of that issue. So the underlying issue is really how do you balance the system? Or if you have a serious run on the whole thing, like back in 1992, basically the government takes over the banking sector and that's the end of it.
I think the bigger problem is some of the legislation, at least, is floating around in the US Congress, which is that stablecoin issuers should have a charter and should hold all their backing stuff in cash at the central bank, and the central bank would pay interest. That's where you have a systemic stability problem, right? Because then if there's any worry about the other banks, all the wholesale guys are going to withdraw from the Citibank and go to one of these narrow banks. So that's just creating systemic fragility. I mean, the proposals in the U.S. Congress that are being floated are all very scary, I think. And I have a very simple point of view. I think we've already shown in the history of every country that the central bank should have a monopoly over circulating currency. But that's not even in the conversation, which is what makes me very pessimistic about the future. I don't think it has anything to do with the strength of the dollar. I think that's based on fundamentals. I mean, the Fed's policy has a big negative impact on lots of countries, but I don't think central bank digital currency. I mean, I think, as Stefan has stressed, central bank digital currency you should think of as it's cash only in a different form, right? So that's not going to, I think, change a lot of these other issues.
And we can argue about whether the present system on the wholesale side, cross-border, is good or not so good because it's costly and it takes time and all the rest of it. But basically, the wholesale part has been digital already for decades. Ideally, of course, you would have global coordination, but global coordination is not going to happen given the way the world works now. So in our case, we just took note of the fact that physical cash is about to disappear. And then we ended up being ahead of some others. It was pretty much the same in 1668. So in that sense, there's nothing new under the sun. Things happen, and you have to deal with it. My hope, in a sort of a good scenario, is that if we can come up with something that makes sense on the legal side, maybe that's a tiny bit of guidance to others. And they can read what we have produced and they say, well, maybe there's sort of an element of intellectual truth in this and maybe we can use it. The ECB, they are working very substantially and at a fairly rapid pace on the same issues. And if I recall, I think that the ECB has been told by the European Parliament to speed up what they are doing. And if that is what happens on that side, then it's fairly likely that eventually we end up with some kind of a legal framework at the pan-European level. And then regardless of what we do, then we probably would have to adjust to that, and that would create more standardization within Europe, and I think that that's a good thing in itself. I mean, they're running experiments in China already with their own CBDC for millions and millions of people, but whether they have a sort of a legal basis for what they do or do not do that would considered to be in some sense firm outside China, I don't know. So like all these other experiments that Gary showed going back a couple of 100 years, we will go through a process similar to that. But eventually, given that the marginal cost of moving money across the globe, that creates a very, very strong incentive for standardization. Because if the marginal cost of moving money around, then it would be helpful for everybody and a huge gain for society if you can actually understand what you're moving around. I mean, all of us are producing a good called money. and it's a competitive business, despite the fact that most people don't think about it in that way. And we do know from a huge number of other cases that let's say, for the sake of the argument, that if you really destroy the value of your own money, then people will opt for somebody else's money. And that is already the case in a good number of countries where they have huge economic problems. Take Argentina, take Venezuela, take Ecuador, Botswana. And in those countries, either they dollarize or they go for Bitcoin or they go for God knows what, because that's their only choice.
I think it's important to keep in mind there's two technologies we're talking about. The central bank digital currencies in China, or the sand dollar in the Bahamas and in Brazil and so on, those are not blockchain based, right? So those all go through the central bank servers. And that's fine, but then there's this other technology, the blockchain technology, and that's what these central bank cross-border experiments are involved with. You know, how does my blockchain talk to your blockchain? And that's where this international coordination, you know, just hasn't happened. It's really sad to watch. I mean, and I somehow, it just doesn't seem like there's any leadership, and it's just everybody sort of does their own experiment and writes a paper about it, and then we all go back to work.
I mean, the reason for my getting so excited about this is it makes me think about how cell phones were introduced. The NMT system was the first cross-border cell phone system in the world. And we pulled it off in this corner of the world. And that means we certainly have both the technology and the capability to do this if we want to do it. And that's why it would be wonderful if we could pull it off between the Nordic and the Baltic countries, because we are enough lookalikes in order to maybe make it possible.
The Fed is light years behind. The Fed has not been involved with any cross-border experiment with any other central bank. They have very little understanding of the technical aspects of blockchain. They make statements like private money has coexisted with government money for centuries. You know, they forget that demand deposits are insured, so that's essentially government money. So it's very frustrating. And I can tell you that the national security people are very frustrated with the Fed as well. And I don't think the Fed really realizes that that's a problem. And the Fed thinks they're independent, but if it's a national security issue, it's not clear that they are independent. So, you know, one of these papers that I wrote with my former student, Jeff Zhang, who is a lawyer, you know, was solicited by the Harvard National Security Journal. And it's precisely for these reasons that they're having a big conference around our paper. It's very flattering. But I look at the participant list, and I don't recognize any of these people. They're not economists. They're all from all other areas that Stefan was mentioning. And so I think there's a growing concern about the Fed in this regard.
And the Bank of England?
Bank of England is further along, and they've conducted cross-border experiments.
The US dollar is very different currency from, I mean, it's the world currency.
But I don't
Does that
think
matter or no?
that doesn't matter.
I also think that what happens here is that you have many more individuals who have studied monetary policy than monetary theory, because most people have never ever studied monetary theory. And if you come from the monetary policy side, basically you assume that the system is constant. And if somebody shows up trying to mess up your system, then you tend to say, stop it. And
that's a very, very important point. I mean, I'm so happy to hear you say that. I mean, before the financial crisis, the resources in central banks were completely misallocated. They had 600 economists who studied, you know, inflation and monetary policy, and no one knew what a financial crisis was. Before the financial crisis, you never heard the word systemic risk in a central bank in a developed economy. Now, everything's a systemic risk. And so it's you know, now they have all these people working on financial stability, but financial crises are a low frequency event. And so, you know, you work in the financial stability division, you have to write a report every quarter, and what are you going to say? You can't say, well, there's no systemic risk this week. So you start looking at things. Anything that's big is a systemic risk, and then we're kind of lost.